There's a short stretch of years in early retirement where your tax rate drops to the lowest it will ever be again, and almost everyone sleeps right through it and pays for that nap for the next 20 years. That stretch is the conversion window, and using it on purpose is one of the most powerful money moves you'll ever make. In Part 1, we covered your 3 tax buckets. In Part 2, we covered RMDs and the age 75 tax bomb. Now we connect them because the gap between when you stop working and when forced withdrawals begin is pure gold. I'm going to walk you through how to use it in order from the first thing you check to the last button you click. Start by picturing your income as a staircase. While you were working, you stood high up on a steep step in a high tax bracket. The day you retire, you step way down. Most folks just enjoy the lower view. The sharp ones use that low step to act. Say you retire around 65. You haven't claimed big Social Security yet, you're not taking required withdrawals yet, and for a few years your taxable income can fall through the floor. That dip is the whole opportunity. So before any steps, get clear on the move itself. A Roth conversion means you shift money from your traditional IRA into a Roth IRA and pay the tax now. Why would you volunteer to pay tax? Because you pay it while you're standing on that low step instead of later on a high one. Every dollar in a traditional IRA is a future tax bill that keeps growing. Convert it cheaply now and it grows tax-free in the Roth forever. You're trading a small known tax for a giant unknown one. The clock matters here. At age 73, as of 2025, the government forces you to start required minimum distributions, and those can shove you into a higher bracket whether you need the cash or not. That's the moment the window slams shut. The richest part of the window for a lot of retirees lands in their late 60s to early 70s, the 69 to 73 stretch. Leave a big traditional balance untouched and it keeps compounding. Then RMDs hit, Social Security stacks on top, and you end up in a higher bracket in your 80s than you ever planned for. Act early instead, moving a chunk each year, and by 73 your balance is smaller, your RMDs are smaller, and your tax bill stays calm. Same money, very different outcome. Now, the actual walkthrough. Your first move, this week, pull up your traditional IRA balance and your age. If you're retired and not yet 73, you're standing right inside the window and the clock is already running. The second move is to estimate your taxable income for this year before any conversion. Add up pensions, interest, part-time work, and any Social Security. That number tells you how much room you got left inside your current low bracket. That room is your runway. Third, pick a target bracket to fill. Find the top of a low bracket, like the 12 or 22% step as of 2025. Convert just enough to reach that line and then stop. You're buying tax space at a discount instead of paying full price later. Write the dollar figure down so you don't accidentally overshoot in December. The fourth move is the one that separates the calm from the stressed. Spread it out. Instead of one giant conversion in your final window year, move a steady amount every year from now until 73. Smooth and boring beats one big lumpy tax hit. This window rewards patience, not heroics. There are 2 technical things to handle while you do this. Pay the conversion tax from a regular taxable account, not from the IRA itself. If you pull the tax money out of the IRA, you shrink the amount that gets to grow tax-free, so keep every converted dollar working for you. And know that each conversion starts its own 5-year clock before you can touch that money penalty-free if you're under 59 and a half. For most retirees inside this window that's already cleared, but it's worth knowing the timer exists. Your final move, every single year, before you click Convert, run the numbers or talk to a tax pro about the cliffs. Convert too much and you can trigger higher Medicare premiums later, called IRMAA, and make more of your Social Security taxable. We'll dig deep into IRMAA later in this series, so for now just respect the edges. One afternoon of planning here can be worth tens of thousands over your retirement. This is the rare homework that genuinely pays you back. Let me make it concrete. Say you've got $600,000 in a traditional IRA. Do nothing, and by your mid-70s RMDs plus Social Security could push tens of thousands of extra income into a higher bracket every year. Run the other path, converting a steady slice annually at a lower rate, and studies from major retirement researchers suggest a well-timed conversion strategy can add years of extra spending power to a portfolio. That's real money, not theory. A quick bit of history so you trust this isn't some gimmick. The Roth was born in 1997, named for Senator William Roth. For decades, the wealthy have used conversions to control their lifetime tax bill. This isn't a loophole or a trick, it's a planning tool sitting in plain sight. And don't forget the legacy angle. A traditional IRA passed to your kids becomes their taxable income, often during their peak earning years. A Roth passes mostly tax-free. Converting now quietly hands your heirs a far cleaner inheritance. If this all feels intimidating, that's completely normal. Nobody teaches this in school. But you don't need to be a genius. You just need to notice the window exists and take a few deliberate steps inside it. Give yourself permission to start small. Even converting a modest amount this year builds the habit and shrinks that future tax bomb. The people who win at retirement taxes aren't the ones with the biggest portfolios. They're the ones who paid attention to timing. You're already ahead just by understanding this. Think of every conversion year as buying back your future freedom at a discount. The dollars you move now are dollars. The IRS can never tax again, and that's about as close to a guaranteed win as personal finance ever offers. This was part 3 of the retirement tax map. Next up, we build an actual conversion ladder year by year, so you know exactly how much to move and when. The window is the opportunity. The ladder is the plan that uses it. So tell me down in the comments, what part of retirement taxes do you want me to break down next, and what did I gloss over too fast today that you wish I'd explained slower? I read every reply and I build future lessons straight from them. If this finally made Roth conversions click, give it a like so YouTube shows it to more retirees who need it, and subscribe so part 4 lands in your feed the moment it drops. See you in the next one.